Good afternoon, everyone. Welcome to the CAPA weekly Zoom live talk for students. This talk was organized by CAPA HC, Chinese American Parent Association of Howard County. And this event is sponsored by COED, Howard County Community Organizations Active in Disaster. So today we have Mr. Vipin. He's going to talk about capital markets, crises and recovery. He is a Howard County resident. At his spare time, he's also a president and CEO of an investment consulting company. He's also a committee member of an organization, FEI. So Vipin, let's welcome Mr. Vipin.
Oh, should I start? A very good afternoon to you all. I heard last week you had, witnessed a magic show. And I wish I was that cool of a person and I could conduct some magic. But short of that, I'm just a simple investor and I love investing. I can't do anything else, so maybe that's why I love investing. There's nothing I'm good at apart from that. But in this presentation, which I think I'll talk about some basic definitions of investing, and then talk about previous capital markets crisis, then current crisis, and then we'll end on a positive note. Because investors inherently are more optimistic people. And you need to be optimistic if you are going to give your money to somebody else. You should expect a return on it and a return off it. So let me share my presentation and you can let me know if you see it. Oh, Yun, can I share the screen?
Yes, I think you can.
It is the host disabled screen sharing.
Okay, so I will make you host then.
Okay.
Okay. Please let me know if you can share your screen now.
Okay, let's see. I think this is it.
Yes, we can see your screen now. Good.
Okay. So, now any investment presentation has to start with a disclosure. And we all do that. All presentations have a disclosure. Things can go up as well as down. Past performance is not a guarantee of future results. It's like taking an elevator. Most times it goes up, but sometimes it can go down. So if you're going to invest money because I told you to do something, don't do that. Ask your parents. Now, some basic definitions of investing. Investing is a very old profession. If you are from India, you would know East India Company. Well, East India Company not only owned India at one point, but also was, owner of the first stock exchange in Netherlands. So it's a very old profession, and investing is very simple. Investing simply means giving money on credit. Giving money to someone on credit and then expecting a return off it and a return on it. We investors make everything very complicated. Finance professionals will make very complicated derivatives, bonds, stocks, nothing. It's all about giving somebody money and then expecting a return on it and a return off it. And there are two kinds of credit. Two ways to give somebody a money. One, you can give somebody a money for a fixed period of time on a certain interest rate. It's more safe. It's called fixed income or bonds. Or two, you can give somebody money as equities. And I'm going to go over each. The price of credit or the price of money is what? It's interest rates. So these are the only simple concepts, and we will make them very complicated, but it's basically nothing. The world is all about interest rates and how you give credit. Uh, so, what is a bond? A bond is simply an investor lending a fixed amount for a fixed term on an interest rate that can be fixed or floating, but on a certain level of interest rate. Depending on the riskiness of the bond, you get your interest rate. Government bonds have lower interest rate because they're not risky. US government will stand behind their bond, give you your money back, give the interest. There is no risk. So it's a lower interest rate. Corporates have a higher interest rate because, hey, they can file bankruptcy, they can go under. It's not safe. Interest rates are dependent on safety and duration. Duration meaning if I give you money for overnight, I know I'm going to get this money sooner. I'm parting with my money for a short amount of time, so I charge you a lower rate. If I'm going to give you money for 3 years or 5 years or 10 years, I should expect a higher return because I'm giving up my consumption of that money for those many years. So that is called bond. Now, what is a stock or a share or equity as we call it? Well, it is nothing but like a pizza slice. You know, when you have a big pizza, depending on how many slices you have, that's your interest in the company. It's it's the claim over residual income, and let me make it. It's a claim over profits of the company. So I'm taking more risk. Company may have a profit, it may not have a profit, but I still want to get paid. I still want dividends. Companies give dividends. And that risky part of credit is called equity. So Apple stock, Google stock, these are nothing but your claim, your percentage claim on any future cash flow that the company may give you. Now, how is the price determined? In finance, there are only two concepts. Everything else is a derivative of these two concepts. So in your schools, in your middle school, in your high school, you should focus on two concepts if you want to go for finance. One is net present value. So present value of future money. If I'm going to give you $100 10 years from now, what is its value today? So that concept is called net present value. And the other concept is probability. And maybe high school kids are doing probability in their school. Um, these are the only two concepts that I think I use in my life to price any security. Now, probability functions can be very complicated or very simple, but if you are going to make a career in economics and investing, probability and net present value are the only two things you need to learn. Everything else is not relevant or part of this. We will make it complicated, but if you know these two concepts, you're golden. And so what is a portfolio? I'm sure you all kids have done Legos. And as you build things in your Legos, I build clients' investment. I add their bonds, their stocks in a way that at some stage starts looking like a portfolio. So portfolio is nothing but simply an amalgamation of stocks and bonds which are tailored for a investor's needs and targets. Okay, so you all have heard of Darwin and you all have heard of theory of evolution. You can either go to those islands, Guapos Islands, and observe Darwin, or you can go to New York Stock Exchange and observe Darwin every day. It's survival of the fittest or the survival of the learners in its best form. So in capital markets, it is not the tips that survive, nor the most intelligent. It is the one who constantly learns. And if you are learning constantly, you will survive capital markets. And there are only two kinds of investors. One who have been humbled by the capital markets, and I say this to my team all day long. One who have been humbled by the markets, and others who will be humbled, who are waiting to be humbled. So only two kinds of investors. Not every investment you make, not every credit you give will make you money. But let's hope you hit some home runs. And that's what life is about. So Darwin, in its most crude form, is practiced every day on New York Stock Exchange. Uh, Markets go down, and we have one right now, but the markets have gone down before too. There have been many previous crises since the history of the stock market. In 1600, actually, there was a tulip mania. People were betting on tulips. Very famous story. Maybe you should read it. How people were pricing and paying for tulips 3 years in advance. Tulips would go 3 years from now and people would pay for the tulip right now. These are manias. And my first bubble when I was an investor was in year 2000. And it was called the dot-com bubble. Technology stocks became very expensive. When I say expensive, remember I said net present value of future money? That concept was broken. There was no future money, so I could not discount net present value. And since that concept was broken and I was still paying for those shares, at some point the bubble burst. And as the bubble burst for 3 years, and that's when I started my career, 2000. And my first 3 years of my life, it was all negative. 2000 market was negative, 2001 was negative, 2002 was negative. But yet, there's always something going on that's positive. There's always bargains that you can hunt. My second crisis, big crisis, was in 2008. Your parents can talk more about it to you if you want, but it was more about housing. And again, as I said, we investment consultants make everything too complicated. We called it the subprime crisis. Subprime is what? Subprime means risky borrowers. So when I give money to people who may not be able to pay back, and I don't charge them adequate interest, I'm taking a risk. And since money was cheap, I took that risk in the hope of making money, not me. But that's what economy did. And you can see the domino effect. People could not pay their housing loans. And if you could not pay the housing loans, the companies that were issued you the housing loans went bankrupt. The lenders went bankrupt. And as lenders went bankrupt, home builders, United States market, the entire economy went under. Just because a few bad apples, the entire neighborhood was destroyed. The entire economy was destroyed. Now, as I said, market recovers. Market is run by optimistic people who always will find bargains, who always will find opportunities, who will figure out the right price for the thing. Because if you look at this chart, there's something very interesting going on. This is the stock market. We call it S&P 500 index, but it's just the collective value of the equity markets. Can you see the .com year 2000? Market went down from 2001 to 2002 and then went back up, and then severe crisis from 2008 till about 2009. And then look at the run. You don't bet against human ingenuity. You don't bet against investors, because investors figure out bargains. The price becomes right. In the short term, markets always trade on three things. So if you're looking at a stock or market to invest as you grow up, remember, in the short run, the market trades on three things. Hope, as I said, investors are hopeful people, positive people. Euphoria, sometimes we get bubbly, it's irrational exuberance. And three, fear. So right now, market is trading because of COVID-19. And I know talked about pandemics 2 weeks ago. Market is trading on hope and fear. The day there is hope because of a Gilead medicine or some treatment coming through, you see market going up. The day you see a bad study about a drug treatment or a vaccine, you see fear and markets go down. But markets always adjust in the long run to trade on economic fundamentals. So short run is hope, euphoria, fear. Overall, market runs on only two things. Future cash flows. Remember, net present value of future cash flows and interest rates. Because how do you make it net present value? You divide them by the interest rates. So as the rates are low, the value is high. So if you look at this chart, what can you see? The blue shaded area is much bigger than the orange area. The orange area is recession, meaning markets going down. But if you look at the blue area, you can see gains, or market has gone up more in expansion than it has suffered losses during recessions. So if your parents and you made some investments and you lost some money, well, if you made the right investments then, chances are you will do well in the long run. Whenever there is a decline in the market, there are more opportunities. And if there is a decline, the job is to hunt for opportunities. So the current crisis, remember this picture? We can go up as well as down. And so this is what has happened in the current market. The blue bars tell you what has gone down. Well, pretty much everything has gone down, apart from two safe things. As I said, US government bonds were safe and gold was safe. Gold, the precious metal gold. Apart from that, everything, if you see in the blue bars, has gone down. The orange bars is what they did last year. So last year was a good year. This year, no matter where you were invested, no matter whether you were in bonds or stocks, whether you were in Mexico or United States or in China or in India, everything has gone down. in my life, I have never seen a more ferocious decline. I've never seen a faster decline. It could scare anybody because when you see money um, going down the drain, or that's what was happening, in 22 days, if you can see from this chart, the market was down 30%. Market has never been down 30% in 22 days. It's the fastest decline. Uh, but whenever there is an indiscriminate decline, there are opportunities. And that's what a good investor picks it. That's when the good investor starts investing. And the authorities, that include the Federal Reserve, the administration, have come up with a lot of support for capital markets. And remember, you may not remember, but and your parents may. It took the Federal Reserve 7 months in 2008 to come up with a policy after the first decline. I think in this downfall, within 3 weeks, the administration and the Federal Reserve have responded in a very big way. So what did they do? They lowered the interest rates. Now, we have a saying in our investing world, the taller the Fed chairman, the taller the chairman, higher the rates. But, you know, so what do lower interest rates do? Again, going back to my first definition of net present value of money. Remember, future cash flows have to be divided by interest rates. So if you lower the interest rate, that increases the net present value. That means stocks go up, bonds go up, because you have lowered the interest rate, which we call the discount rate. And the Federal Reserve has done an unprecedented um, stimulus in the market. Now, we are at a pause. We are at a pause because not everybody is certain when the markets when the economy should open up. There is a debate between epidemiology and economics, and it should not be a debate. You cannot sacrifice one thing for the other. You cannot sacrifice health for economy, and you cannot sacrifice economy for health. And in the absence of solutions, we always have to look for options because investors are an optimist people. So you have to craft your options. And let me give you something positive. And this is, don't worry about what this chart is about. This is about how manufacturing in China went down and how it is coming back up. A virus has never defeated mankind. And it's not going to start anytime soon. If you look at China, on the left side is manufacturing, on the right side is services or non-manufacturing. Everything went down. This is the same thing that's happening in the United States now. But the rebound has been swift. In every crisis that I have witnessed, 1/3 of the economy comes back very quickly, and 2/3 take 2 to 4 years to come back. This crisis is no different. I'm assuming because of the unprecedented stimulus that the Federal Reserve and the fiscal stimulus by the administration, that instead of 4 years, it might be 2 to 3 years for the economy to come back. And as Federal Reserve lowers the interest rate, there might be a slight disconnect between capital markets and the economy. Because if they lower the interest rate, what does it do? It brings the net present value up. And when you see stock prices go up when Federal Reserve starts buying. When they lower the rates, both stocks and bonds do well. Yun, that's what I have, and I want to ask for questions.
Thank you, Vipin, for the great talk. So anyone who have questions, you can unmute yourself and ask question because right now everyone is on mute. Please unmute yourself if you have a question.
And remember, there is no bad question. I'm just a bad explainer.
Oh, I saw one question in the chat. Is it possible that the market never recovers?
No, take that to the bank. This no, you can take it to the bank. Market will recover. It has always recovered. It has gone through many. It has gone through two world wars, a Great Depression, a Great Recession, and no, it will. Remember, as I said, the money lending, which we saw as a stock exchange, is nothing but an organized money lending place. Uh, it survived hundreds of years. It's not going to die. In fact, in the history of capital markets, and when you go to New York, ask your parents to take you to New York Stock Exchange. You can sign up for a tour and go inside and read the history. It used to be under a tree, and there, what is called Wall Street was actually a walled street. There was a wall there, a long wall along the street. It was the bank of the river, Hudson River, and under the tree, people used to trade U.S. Treasury bonds. Sometimes, and when it rained, there was no trading because it was raining. But the trading happened under the tree. So you should go there and see how it has evolved. So market will always recover. Um, our time period should be long enough. That's all.
Oh, there's another question. What does PMI stand for in this chart?
Oh, I should have said it's Purchasers Managers Index. It's a survey that a company, actually, it's a company called Market, Markit, that conducts for every country. And a reading of 50 above means economy is expanding. More than 50 means expansion. Below 50 means recession or contraction. So you see China, it contracted and the number came below 40. And now the PMI, or the Purchasers Managers Index, meaning the economy is expanding again. The number is over 50. And that's all we look at. Under 50, over 50. That's the only relevance of this chart. I hope it answers your question.
Yeah, thank you, Vipin. I saw the reply. Thanks, it does. Yeah. Anyone have more questions? You can either unmute yourself or type in the chat.
Yeah.
So Vipin, what I see in this chart, so I look at the average PMI and also you have plus and minus one standard deviation. So generally speaking, it's above 50. But the PMI minus one is 48.46. So that's a little bit lower than 50%.
Yeah. So it was just so average has been, China has been an expansionary mode for the period that the chart is there. And yes, once in a while, it was in 2008. And now again, because of COVID, economy went into a contraction mode. But the value of this chart is it's coming back. The current reading is above 50. So economy is expanding again. And same thing will happen to the United States. And same will happen to all other countries in the world. Once we come through this, we will be in the expansion mode. Part of it will recover this year. And a majority of it will recover over next few years. Hopefully, with the stimulus, we should be able to recover it faster.
Yeah, and I also see that they seem to follow a little bit different pattern if I compare 2009 with this year. So for 2009, it's because of the mortgage, but this year is because of the COVID-19 pandemic. So I see this year has been mostly impacted the non-manufacturing PMI. Probably it's because people stop going to the restaurant or see movies or lots of entertaining. And the manufacturers seem to be, well, still be impacted, but not at the same level as the non-manufacturing.
You're absolutely correct. Um, and remember, it impacts US a little more because 70% of US economy is services economy, which is unlike China. So it impacts US a little more than it impacted China because, as you rightly said, Yun, is the services sector that gets hit. Manufacturing still can continue under the Defense Production Act. Oh, sorry, I'm getting complicated, but manufacturing factory can continue, but you're not going to restaurant, you're not going to your salon or barber or and all those services have. The other pattern here is it took us a while to come back in 2008. If you see, it's a longer V. It's a V, but longer V. Right now, it's a very sharp V that's coming back, especially in services area. It's a sharper recovery. So um, that's the positive about that I think United States will also have. But let's wait for a couple of months.
Yeah. Let's hope that we can recover soon. Okay. There's another question. Are stocks riskier than bonds?
Yes, stocks are riskier than bonds. Remember, bonds give you a fixed rate of return. And because they give you fixed rate of return, they are less risky. Stocks give you share of the profit. It's not a guarantee you are going to get dividends. What if there is no profit? The company still have to pay its debt or still has to pay its bond, but the company doesn't have to give a dividend on the stock. And as you know, stock market can be a little more volatile depending on the earnings. As I said, in the long run, it's earnings and interest rates. So yes, stocks are more risky.
There's another question. Why was manufacturing impacted more than non-manufacturing in 2008?
Good question. Because in 2008, we never resorted to social isolation. Yes, it was a housing crisis. A lot of people lost their jobs. But, we could still go to a restaurant or a bar. We still needed haircuts. We still needed our regular doctor's visits. So manufacturing was more impacted then. And we thought services would always be more resilient. And we all now know we are wrong. That services can also be sensitive. We all assume like a haircut is a haircut. I need a haircut. I need a haircut. And by the way, the price of haircut has always gone up in the history of mankind. That's the only inelastic, where the price I've never seen go down. So services prices become inelastic at a certain stage, and because we become creatures of habits, we always go to the same restaurant, the same barber, and so we always thought services was more resilient. But as we are learning from this pandemic, that services can be sensitive too if we have a pandemic.
So Vipin, do you have any suggestions or recommendations for those young investors?
If they want to make a career in finance, there are two things I think that help me. One, read a lot. And I know their parents always tell them, but read anything you want. Any knowledge is a good knowledge. Um, in fact, I would rather say have a knowledge that's 6 mile wide and 2 inch deep is better than a 2 mile deep and 6 inch wide. So read anything and everything that you lay your hand across. It doesn't have to be deep knowledge. Um, Math is important, not that much, but you will know what probabilities are very important. And guess what? The movie that inspired me the most, and I told my wife I'm never going to talk about it because she said I should not talk about it, is the movie from 1987, Wall Street. And uh, it, I think kids should watch it and see how cutthroat the world of finance is.
Good suggestion. Here's another question. Are there any mock exchanges for kids to learn?
Say that again, Yun.
Are there any mock exchanges for kids to learn? So instead of the real stock exchange, is there any simulated one that they can learn?
Meaning they want to learn about stock?
Yes, but they want to try practice instead of investing real money. Do you have any simulated programs that they can learn?
Oh, I don't, but I know Fidelity or TD Ameritrade may have some simulations or that they can engage. But let me find out, and I'll respond to you, and you can respond to the people. Let me
Okay,
find.
sure.
I've never done that. I learned through losing real money.
Yeah. And another question is, what is the most important skill needed to succeed in the stock market?
You know, it's a cliche, if I'm going to say, but something that impacts me and but keeps me going is waking up every day and knowing that today is a new day and what happened yesterday has no relevance to what's going to happen today. And the last thing you want to do is sell when everybody is selling and buy when everybody is buying. So what happened? But that needs a lot of courage. It needs lot. You tend to you need to doubt yourself. So there's a lot of self-doubt. So I would say having a little more conviction in your ideas, um, being a little more positive, and they say a new day, every day is a new day. In stock market, that bell rings twice a day, at 9:30 and 4 o'clock, and markets trade all day long worldwide. But think about it. It's going to be different. There might be some dislocation you're going to pick up next day, some opportunity that you're going to find. And there is always an opportunity. Always. I've never found one single time in my life when you couldn't focus on one opportunity and figure it out. I may not be looking hard enough, but there is always an opportunity.
Our next question, do you think the current pandemic is going to produce long-lasting impact on market structure within country and globally, as we will have a new norm, or will go back to before and just takes time?
It's a great question. And let me go back to my Darwinian slide and say markets adapt and learn, but they are never the same. A lot of sectors have never come back in life. Things change constantly. The value of certain sectors. So when I say sector, I mean real estate, it can be finance, it can be technology, industries. The way you are going to look at telecommuting, telemedicine, the way you are going to look at traffic, machine learning is going to be very different today and tomorrow than what was yesterday. So there are certain sectors in 1920, 1940s, the most expensive stock used to be energy companies and utility companies, companies that supplied electricity. Today, nobody knows those names that supply you electricity. Nobody trades those names as much. There is Exelon, there's Entergy, but nobody talks about those. You talk about Apple, you talk about Google, you talk about Tesla, and things change. Um, Great companies of yesterday may not be great companies of tomorrow. And very few of them actually survive. If you look at Dow 30 index from 1930, so there are 30 companies in Dow 30 index, right? There are only 3 today that were in 1930. 90% of them have vanished. You know, so it's not going to be the same. The way we socialize may change, the way we may um, consume different goods and services will change. Um, your job is to figure out what's the next big thing and invest in that.
Our next question is, what do you like the most being a professional investor? What do you like the least?
What I like most is, the best learning comes uh, from clients, from people who ask questions. So my clients who give me money to invest ask me a lot of tough questions, questions that can make me very, very uncomfortable. But uh, I love the fact that at some stage I'm hungry, I'm greedy for returns, and I love the fact that I can remain greedy for so long. So hungry, greedy is all good. I know your parents will tell you otherwise, but hungry, greedy is good. And um, so I like that. I like capitalism. I love working in capitalism. Sometimes I win, sometimes I lose, and not all ideas work. Hopefully, more ideas work than not. But I love the fact that I do this. Um, and what I like the least, um, I think it's the um, I don't know. I think I've never found anything that I don't like in investing. I like losing sometimes too. Don't get me wrong. It gives me a lesson, and I'm like, okay, I know what not to do and what did I do wrong. I may be harsh on myself during those days, but there's nothing I dislike. It's very hard to say. I'm sorry, I can't find anything that I dislike.
The next question, are there any specific signs you should look for when considering investing?
I'm going to share that, but don't invest based on this one particular sign. It's called price to book ratio. One particular, don't focus on it as one. Remember, trading is a three-dimensional thing, and I'm giving you one dimension, which is stock price divided by the value of the assets with the company. And if the if the number is high, the markets are expensive because nobody knows what earnings would be tomorrow. So I look at the earnings in the bank or the assets that the company has and look at the price of the stock. That to me is my starting point for every time. I used to look at collective markets. I don't look at particular stocks now. That was my life once upon a time. But collectively, whether the market is ahead. So let me give you an example. During .com, that bubble .com 2000, market was trading at 6 times price to book ratio. I wish I had the chart here. The normal value for that price to book ratio is 2.5. On an average, market trades at 2.5. At 6 times price to book ratio, it was a bubble. Now, your question should be, what was it trading in February of this year? It was trading at 4 times book value. And 4 times book value is not a bubble, but it's a very stretched valuation. So that's why you saw that decline, because there is no value here. There is no value investor coming to buy the market. There is no cushion. So we were already selling a lot of the market in January because there was no cushion. And if there was any decline, there will not be a buyer because it's expensive. But as I told you, when rates go down, value, net present value goes up. So price to book ratio is also a dynamic thing. That's why I said, don't focus on one thing, because that ratio may not be relevant when interest rates are so low.
Our next question. So may job loss and unemployment and the stocks have rebounded or stayed steady? Why?
Say that again.
The question is, so may job loss and unemployment and the stocks have rebounded or stayed steady? Why?
Meaning there has been big unemployment, but stocks have come back, you mean?
I'm not sure. So can you unmute yourself and ask question or clarify the question?
Hey Vipin, this is Negi family. So yes,
Hi.
the question is, with so much unemployment, every month and week we are hearing more and more people lose jobs. The stocks have, the peak was there, that it was quite steep. But still, I think the stock market has kind of stayed steady. We are making quite a few gain. Are you going to say everything is because of the stimulus checks and package?
Well, it's a great question. And a lot of my clients have been asking the same question. Um, and if you saw the time frame, and maybe I can go back to this chart of 22 days and 30% decline. When this happened, in 22 days, 30% decline, I was seeing everything indiscriminately being sold. Companies were drawing their credit lines, and we all heard that. But let me give you a number. On a regular day, I see bonds. There's one category of bond called municipal bonds, which are local state government bonds. And every day they trade around $800 million or so. And I see them coming through. On 23rd of March, I was trying to sell Maryland bonds with a manager for my clients. The volume available to sell was 5 billion. So think of it. Every day trades 800 million. 5 billion now is available to sell. And I saw bids for 7 million. 5 billion versus 7 million. That was the kind of supply demand imbalance. There was no pricing on that security, so everything went down. And then the Federal Reserve came and bought all those bonds on Tuesday. So the snapback on municipal bonds tells you that the Federal Reserve is committed, and the Trump administration is committed with their fiscal stimulus to go all in to support capital markets. So it is not the right reflection of fundamentals today. The fundamentals today are much dire, but hey, we have a very old saying in our business: don't fight the Fed. I may be right in the long run, but I'll be insolvent in the short run. And I don't want to be insolvent in the short run. Does that answer your question?
Yeah, thank you.
So our next question is, given the impact of machine learning and other tech changes, what do you think about the job market perspective in finance in about 10 years when these kids grow up and enter the job market?
I've heard a lot about machine learning, algorithm tradings. So yes, there is going to be a little more technology component to financial job. But machine learning and technology components, as we saw in 2008 and now again, they are ahead of the investors. So what happens is they tend to pile up on one particular trade, meaning the dislocations, uh, they create dislocations also. So everybody comes at the same time. The computers are selling. Before a human can sell, a computer will show up with a lot of sale orders. So there is a technology component, and I think more and more traders are becoming technology savvy. More and more program trading is happening than I ever saw before. I used to trade on the programs many, many years ago, but these programs are like lightning fast now. But you still need a value input to pick up on the dislocations. Um, that I think again, I may be biased, that a human mind can see it better because it's well connected to inside information, outside information, you know, that sometimes cannot be fed into those computer and algorithms. So yes, you may have to take a course in technology if you want to be a trader. Um, that would be the reality. But you still need basic finance, and not get disheartened every day. Um, Clients can be very harsh on you some days, but they can be very good to you anyway.
So our next question is now a good or bad time to invest?
Depends on your time frame and depends on what you're buying. Um, if your time frame is going to be, I don't need this money for next 20-25 years, or um, you know it's a good time to invest, and what you invest is more critical. And then if your time frame is that you need your money next year for your kids college, or then I would say hold your money in cash, or maybe some high quality bonds, um, because that's what Fed is buying. So you should be buying high quality bonds. Why fight the Fed? Buy what the Fed is buying. So yeah, I would go with the depends on the time frame and what are you buying.
Thank you, Vipin. Thank you for the great talk and answering so many questions. Thank you. It's really great to have you.
Ian, it was a pleasure, and I'm so glad that there were a few questions. I wish I could show them some magic to you, but I can't.
Well, you can learn from Praveen. So next year,
I
maybe
know,
you can do this.
I know. Next year, magic show.
Sure.
But thank you so much for having me. Thank you all for listening to this talk, and you know, good luck on investing.
Thank you all for coming. And next week, we'll talk about legal system. Okay. Thank you,
Bye.
everyone. Bye.
Thank you, Ian.